Hello sector watchers, I am Julius de Kempenaer, based in Amsterdam, the Netherlands, and your host for today's show. Welcome to the 33rd episode of Sector Spotlight on Tuesday the 2nd of June, recorded on the 1st of this new month. Sector Spotlight airs every Tuesday from 10:30 to 11 AM Eastern, and you can watch the replay on the StockCharts YouTube channel. I love to hear from you, so if you watch the show on YouTube, please don't forget to like the video. And if you have anything to share, please use the comment section below. Of course, you can always send an email or use any of the social media handles to stay in touch. As it is the first show of the month, I'll be using monthly charts in the overview for asset classes and sectors, and I'll be once again exploring sector seasonality to see if we can find any sectors whose current rotations are lining up with the seasonal expectation for the coming month. Let's kick off with an overview of what has happened in asset classes last month, because it's the first show of the month. We'll go and have a look at the monthly performance, and because the month of May had 20 trading days, what I'm going to do is I'm going to set my RRG to 20 trading days so we can have an overview of exactly what happened in that month, and then rank it on the percentage change. And we'll see that it was a very good month for commodities actually, and then followed closely by the US stock market. We all know that, but here you got it in plain sight. ITOT, core S&P, total US stock market up 5.2%. And we can go immediately to the lower end of the table where we see government bonds with a minus 0.1% performance. VBINX, our benchmark, which is the typical 60-40% balanced index, performed 3.5%. Now, because it is the first show of the month, as I said, we'll throw in some monthly charts to see how the last month's performance impacted the monthly bars that we keep an eye on. Now let's start with the stock market, with ITOT, because it's you know, we've had some wide swings since February. We all know that. And if you take a step back and you look at the longer term chart, and we look at the monthly chart of ITOT here, then you see that February and March, you know, bumped a little bit below that dotted trend line that I've annotated the chart with, but we went back up. If you take a view that an uptrend is a series of higher highs and higher lows, then we would have to conclude that that trend was damaged when it broke below the December 2018 lows. Maybe that's true, but what I started to play with when I was preparing for the show is there was so much noise going on, and looking at monthly charts is already taking a step back and looking at things happening from a little bit of a distance. But another trick that you can do is, instead of looking at a open high low close chart, is to look at a line chart. And if you change this chart to a line and you update it, this was like, okay, here we still have a series of higher highs and higher lows intact. I mean, it was close, but it's still there, and you can see that the dotted trend line is still as I had it with the open high low close bars, but now we lost all the intra-month noise between the high and the low, and this is like the end effect. If you would be an investor that looks at the market once a month, this is what you would see. And you know, if you would take away the fact that it is the US stock market, if you would take away the knowledge that there is a pandemic going on in the world and there's mayhem all over the place, then to be honest, this chart doesn't look really bad. Anyway, if we translate that to SPY, chart that a lot of people look at, I have this chart here, which I haven't changed basically the annotations for this chart for a couple of months already, and you see that the same effect here is in play. If we change this to a line chart, then you will see that this trend is there. We bounced exactly where we expected that support to come in, and we're recovering and we're coming back above these horizontal resistance levels. So the short-term picture for stocks continues to improve, and we have to keep an open mind to that. Actually, let me move to the government bonds. So we got GOVT here. The breakout is clearly there, but since February we've been making inside bars, so that is consolidating, and it's not pulling through as fast as I maybe initially had expected. Same goes for IAF, which is the 7 to 10-year Treasury bond ETF. We see the breakout of that range, and also inside monthly bars being formed, basically indicating a consolidation. Now, I'm going to translate this to our investment pyramid, as you're aware, and that we usually use it here on the show. But I did decide to maintain caution with regard to stocks, but the short-term improvement is definitely continuing, and you can see that here on the RRG, where the daily rotation moved back into the leading quadrant for ITOT, and we had GOV turning back into lagging. And if we go to the weekly RRG, you will see that the make it here that bonds are now rolling over and inside the weakening quadrant, so they now start to shift to the left, and stocks are inside improving, and they start to pick up on the RS ratio scale. In essence, government bonds are still way to the right of stocks, which means that they are in a longer term relative uptrend. They're relatively better, but the trend seems to be changing, and especially when you think back on that daily chart that we had, I think it is wise, although signals, there's not really signals on an RRG, but the trends seem to be shifting back to favor of ITOT. And yes, I know it's been a massive run off those lows. It is a trend following system. There's nothing you can change about that. But I think that this message is now that we should be a little bit more aware of the fact that stocks are picking back up their longer term trend against government bonds. So the short term trend that we have been speaking about for the last couple of weeks is continuing in favor of stocks, and it seems to be picking up on the longer term scheme of things as well. So for now, I want to actually I still remain cautious with regard to stocks, but the short-term trend is picking up, and it seems to get stronger and stronger. So I'm gonna move my view of the stock market for the longer term to neutral. It was a negative. I'm now moving it to a neutral. The shorter-term trend that we had on it's doing very well, that obviously remains. And one of the most important reasons for that is the ITOT GOV ratio. And as you can see, that damage was done. The reason why I still remain cautious is because we are in a difficult area here, where we had a cluster of lows over the last 2 years. We need to see if the market can take that out and push back up. Short term suggests yes, but long term we really need to see that. Wrapping up the asset allocation bit with the pyramid view is this one here, where we continue to have real estate as an underperformance. As I said, government bonds from positive to neutral. High yield remains an underperformer. Stocks go from underperform or caution to a neutral. The US dollar remains neutral. Commodities are still a clear underperformer, and corporate bonds continue to do well. By the way, that's one chart that I wanted to actually share with you, because that's also a very, very interesting chart. That's the LQD chart. especially when you do the same trick with the line chart. So here's the chart of corporate bonds. We see that wild swing in February going back above the range, and watch this. If we change the bars to a line chart here, as if nothing happened, you see a nice break, you see a pullback towards the resistance that's starting to act as support, and now we're pushing higher. So stepping back is always a good idea. Looking at monthly charts is always a good idea. And if things get really, really difficult, I find that changing the bar chart into a line chart gives you even a little bit more big picture perspective. And that's what it's doing here. So the corporate bond market doing exactly the same as that we saw with those line charts in stocks. And so this wraps up the asset allocation part of the show. If we then move over to sectors, I want to use the same approach. So first, set up my RRG for sectors looking back 20 days. I need to do that here, 20 trading days. Update. So I got the exact monthly performance. I actually have to shift it one back because the market's now open. So right here, that's until May 29. And sort it on the percentage change column, and we can see what happened in the various sectors during the month of May. And then I want to move that into a quick look at some of the monthly charts for those sectors. And then I want to blend it in or move over to looking at the seasonal patterns, because as you know, on the first show of the month we always look at the seasonal patterns and see if we can find any rotations on the RRG that match the seasonal pattern as we see it usually. So for the month of May, the communications services sector was actually the top performer at 7.4%. And talking about seasonality, that was the pick of the best performer, or the expectation for the best performer a month ago, and it actually worked out pretty well. Technology up there with 7.2%, followed by materials, discretionary, and industrials. The market itself, the S&P, 4.8%, and then below the 4.8, so below the benchmark, utilities, healthcare, and also financials. And financials was our pick for underperformer this month. So for the month of May, the seasonal / rotational pattern worked out pretty well. Now let's have a look at the weekly RRG here, and then bring in some monthly charts. Let's make this a little bit shorter so we can actually see what we're doing. Now I'm not going to walk you through all of them, a lot, but not all of them, because that would take up way too much time. But materials is worth looking at because it managed to get back above that rising support line very rapidly, and there is plenty of space until it reaches the all-time high levels, which are just above 60, around 62. The XLB is a sector, especially when you look at the tail on the RRG that's heading towards the leading quadrant, that I think is worth keeping an eye on. Now the second one is communication services. That's doing very well, and it's almost getting to new all-time highs. And again, if you would, let's do that, just look at that line chart for communication services, you'll see that we're actually pushing to new all-time highs. So it's just a matter of how you look at things. This is, again, you know, you don't know it's Corona, you don't know we've had all these wide swings. You look at this chart, you think, hey, that's a good chart. And it is, because all these lows are still higher and we're now pushing to a new high. So communication services remains definitely worth our attention. If we then look at energy, that's the other way around. It was a very strong sector in the last month. It was, if you go back to the start here, if you that's also a cool thing to do. If you line up the tail with the low and then sort on performance, you see that energy with 54% was the top performer. Now look at this chart, it's 54% from a very low level. We had this massive decline. That doesn't make me very comfortable and enthusiastic about long positions in the energy sector. As a matter of fact, I think it is about to run its course. We're in a heavy resistance area, so I will be very, very careful with the with energy, even though the tail is right up there inside the improving quadrant, but it is way down to the left. The other one that urges caution is financials. If you look at financials, broke out of the channel, did not manage so far to come back into that channel. Compare that to the other sectors like materials and industrials, who've all come back into that channel. So the financial sector really got hit with some damage over the last few months. It didn't merely get back as high. Look at this, this is 26% of that low, with 40-50 for discretionary materials, energy. So financials remains a sector to watch out for. For me, it's definitely not one that I would be looking for substantial long positions right now. If we then go to industrials, you will see that we are back into the channel, but we are running into a resistance area around 70. That makes me a little bit cautious with industrials. Definitely also because it's inside the lagging quadrant. We've been picking up a little bit of momentum, but we're still far to the left. As a matter of fact, it's the third sector from the left. So if you take the RS ratio as your yardstick, then everything to the right, or the highest to the right, is good, lowest to the left is weak, and then industrials comes in as third from the bottom. So that's definitely not a very good sector, and the monthly chart actually confirms that view. So in order to improve further, I think we should take out 70 US dollars, and whether that's going to happen, I don't know. This looks like a serious resistance level coming off these monthly lows out of 2019. Technology, that is a very strong sector, and if you look at the tail here on the RRG, you see that it's been rolling over, it's stable, it's inside, it's orange, so it's inside the weakening quadrant, but only just, and it's got a very short tail. And if you look at that monthly bar chart, you see that these major lows are all still higher. The sector managed to get back above its resistance level that marked the development of that new channel, and we're now challenging new all-time highs. And again, if you switch to a line chart, you will see that we're actually pushing to new all-time highs. So technology remains definitely a sector to stay invested in, but there are some caveats that we will look at later on when we start looking at seasonality. Two more, staples. That is right in the middle of its channel, but it's not accelerating anymore. So if you compare that with the position on the RRG, you see that it has rolled over and it's now rapidly heading towards the leading quadrant. So the monthly bar chart, the trend is still there, but it looks as if other sectors are starting to overtake the consumer staples sector, which is, you know, when stocks are in favor and people are getting a little bit more aggressive, a little bit more offense orientated. Staples is one of the sectors that start to underperform. Nevertheless, this super nice long-term uptrend, there's nothing wrong with that. If you like a stable return, then by all means, staples is definitely a sector to have at least some sort of a holding in. And finally, the healthcare sector, that in these day and age, that remains a very interesting sector. You see that it's rolling over, but remember what I said about using RS ratio as a yardstick. The healthcare sector is the furthest on, well, together with, they're almost overlaid. Let's zoom in here. Technology and healthcare are, well, I can't even see the difference. They're almost the same. So number 1 and 2, healthcare and technology, but both are losing relative momentum. Let me bring up the technology chart here. and you will see, oh, I was going to say, did we show this? The healthcare chart. So let's bring the healthcare chart, and you see that it is actually pushing against that all-time high. We may see some sort of a rotation out of it, but there is plenty of room in this trend, plenty of room to wiggle and to move before this thing turns around. So healthcare remains a very healthy sector. So for the monthly charts, this is what I wanted to share with you. Approach, and we got the, let me bring that up, the chart with the seasonal performance of all sectors. Just as a reminder, this shows you the outperformance per sector per month versus SPY, so it's already a relative chart, and what the numbers here are percentages showing the percentage of time over the last 20 years when the sector has outperformed SPY. Obviously, we're looking for significant numbers. So for the month of June, that's the month that's coming, there's not too many super high or super low values, because when it's super low, it means that it's predominantly underperforming SPY. Now, I've highlighted a few sectors here. Clearly, the two that stand out are healthcare, with 70% of the time outperforming SPY, and technology, surprisingly, only 30% of the time outperforming SPY, which means that 70% of the time technology is underperforming SPY in the month of June. That's an interesting thing I want to explore a little bit further. Now, the other ones that I've highlighted, they're at lower values. So on the plus side, we have communication services at 58. Looks to me as a good follow through of these strong months, and especially the month of May. So it looks as if June still should be okay for communication services, and especially if we peek ahead a little bit to July, where again it approaches the 70% barrier. So the communication services area, I think, could continue its positive run as we've seen it in May. Utilities outperformed the SPY 60% of the time. I'm going to look at the rotation in a minute. And then on the negative side, next to technology 30%, you see industrials only outperforming 40%, so underperforming 60% of the time. That's a negative connotation. And the same goes for financials, where just like in May, you see a number of 35, which means that in 65% of the months the months of June over the last 20 years, 65% of the time financials underperformed SPY, and the same goes for consumer discretionary, which underperformed SPY for 60% of the time. Now let's take a look at, let me position this here a little bit to the left, to the right, because then I can actually see my RRG. And let me highlight those tails so we can see communication services. That makes sense. That is a tail that matches the expected seasonal pattern. Not a big number, but it's still pretty good. If we look at financials, then you see that it is way down in the left in the lagging quadrant. So for me, that still matches that negative connotation. So I don't think that this is going to be a super duper sector in the month of June with a position like this, way to the left. If we move to industrials, it's the same story. It is expected to underperform, and with a tail far to the left, second from the bottom, you can actually expect a further underperformance. The short term is looking sort of okay, it's picking up a little bit of momentum, but the position inside the lagging quadrant and the weak expectation based on the seasonal pattern makes me quite reluctant to actually get into strong positions for industrials. Now look at technology. Here we are actually going opposite each other. So the chart for technology, as we just saw it, is very nice and very strong. The rotation is not bad. It's going through a little bit of a hiccup, but this is not a bad rotation. It's a very short tail. It's way to the right. It's still one of the stronger sectors. It's pushing to all-time highs. So I'm cautious about this underperformance. So this expected underperformance does not really match what we see on the RRG at the moment. If we then go to utilities, that's a little bit similar because we would expect an outperformance, but look at the rotation. That is suggesting a further underperformance. So here also we have a clash between the seasonal expectation and the actual rotation on the chart, which means that you got to urge a little bit more caution. It's not like something you want to actually put on maybe big positions, so to say. And finally, there is the consumer discretionary XLY, which is moving into the leading quadrant, still pretty strong. But according to the seasonal pattern, we should expect an underperformance going forward. Now we all know that this is pretty distorted trail because of Amazon, but this is what it is. This one also has Amazon in it. So here also a clash between the rotation on the RRG and the expected seasonal pattern. Now, where does that leave us in terms of good potential? I think that the outperformance that we see for the healthcare sector, the tail, and then what I was actually wanted to say is the strong number. So the expected positive return, the expected outperformance for the healthcare sector in the month of June, together with the high position on the RRG, that makes me feel strong about the healthcare sector going forward. And on the other side, the financials sector is confirming what we expect based on the weak seasonal pattern. So if you want to put on, a long and a short, we're going to add them to our basket in the pair trades that we're maintaining as a basket as of now. If you've seen last week's show, I stopped doing the one-on-one, so I'm going to add financials in the short basket. I'm going to add healthcare in the long basket actually. Now I want to bring that to the investment pyramid, and if you take a look at that and move all the way down to the sectors, I think that the move in materials actually warrants an upgrade to positive from neutral. These are all unchanged, and consumer staples is, as I said, it's losing the race. It's going back to neutral. It's still a strong trend, but it's not an outperforming anymore. It's not running fast enough anymore. And healthcare was already a strong sector, and financials was already a weak sector. So this makes up the investment pyramid for this week, this month. I need to wrap up real quick and write up the pair trade or long short review in an article. So please keep an eye on the RRG blog for that. This was Sector Spotlight. Thank you for watching. Don't forget to like the video and leave your comments below. Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern with replays on the StockCharts YouTube channel. And surely I hope to see you again next week.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.